Welcome back to Golden Rule Radio. Miles and Tori and myself are here in the studio. We have a little bit to talk about today. I think today's program is going to be relatively short. Let's start with silver. Miles, tell me about silver.
Yeah, he's throwing a
Oh, man. Where's my silver chart? Oh, it's right on top.
Curveball.
You know why it's right on top? Because that's what you and I were just talking about, Rob. So silver, yeah, we mentioned this last week. Silver's been stuck in this rising channel for about last year or two that we've come to the top and bottom of. And it's funny, Tori, when you and I were talking 2, 3, 4 weeks ago, we were looking at the bottom that we put in back around where we're almost back to now, 22.30, 22 and a quarter. And one of my arguments was, I think we're going to touch that bottom trend line. I think we might just trickle out here for the next month. And then I think the next day, silver skyrocketed.
Took off.
Yes. So I think I'm going to be right. There just clearly was a massive speed bump in the middle there. So you just never know what the markets are going to do on a day-to-day basis. And I know I've said this for a long time, but when you look at the market charts long term, they tend to trend towards a direction that they were going to get to anyway. But you have these event cycles that happen that sort of throw it out of whack for a while and causes the volatility up or the volatility down. So I think something like this is a perfect example where a month ago we were saying we think silver's probably just going to flatline and end up meeting this rising trend line. Lo and behold, it's probably going to end up meeting the rising trend line exactly around the time we thought it would. We just had this couple dollar up and down in between. And it's kind of interesting to me when that happens.
Yeah, and if we do trickle, that could actually represent a breakdown below the trend line, couldn't it? I mean, if we trickle out far enough and you extrapolate out far enough, I know you like to adjust the trend lines every once in a while based on how things get drawn out. But honestly, that could actually coincide with us breaking below and seeing if we don't come down significantly further, couldn't it?
Well, we're below the 200-day moving average by how much, Miles?
Oh, I think we were down 25, 30 cents below it, so not significantly, but we just broke down yesterday.
Yeah.
So it's not a significant amount, but we did just inch below it and break down below it yesterday.
We have anything fundamentally that would change the direction of silver, or do you think we could just go flat here for a while?
I think we're staying flat until we see something big hit from any number of angles, and we can go into some underlying fundamentals now that most likely are going to be impacting gold more. What I find interesting, you're talking about the silver. Last week's show, I was talking about the ratio not changing, just stuck at 80.
Well, it's 84 now.
It went 82 to 84 just in a matter of a couple of days, and so that is disproportionate weakness on the silver.
It is.
And why is that? Usually, economically, the news is worsening, right? Where you're expecting more industrial slowdown coinciding with not a whole lot of activity in the currency world.
Well, and David and Kevin talked a fair bit about the industrial slowdown this week on the show when he was talking about the BRIC nations and building up their own internal economy outside the confines of OPEC and the U.S. dollar, oil production numbers. But he brought up some of the production changes in fuel over in China, big production shift looking at marine diesel as opposed to other forms of diesel. Marine diesel is a great option if, say, you need to move a land invasion force across a small ocean to a country like Taiwan. Just an idea. I don't think David specifically said it out loud, but I will.
I'm glad you are, because that is a fundamental, right? If something significantly impacts gold like that, right? Yeah. Geopolitical strains always do. Certainly war is the epitome of a geopolitical strain playing out. But if you haven't listened to the weekly commentary, you should do that, because this BRICS meeting coming up August 22nd through 24th is big. It has a lot of our clients concerned, not just about the unification and what they represent from a unified currency standpoint, has a lot of people concerned, but also as a major oil player, talking about getting North African countries and Middle Eastern countries to join this BRICS alliance. This is a different summit. It might be the 15th annual, but it's kind of feeling like the first annual to me, right? So that is a big geopolitical, and we'll see what gold does, especially if they do come out of that with further talk of backing a currency amongst the BRICS nations in gold.
Well, gold and other natural resources like oil. But I only think that works for a handful of the bigger players. Like if you're the House of Saud and you're sitting on all the Saudi oil, you can convert your yuan to gold at the Shanghai Exchange. I'm not so sure the other nations will have that same kind of pull to convert. But it will suck some of the air out of the room, and I do believe could be very fundamentally impacting the price of gold. If they make this announcement, whether or not it pans out for a long term or not, gold's price is going to be affected.
I think so too. And if you look at the big news that's coming out of China, it's really all about their economy, right? Nations turn to war in times of desperation,
yes.
Need for distraction,
yes.
right? The entertainment aspect, the government is the entertainment sector of the military-industrial complex, as Rob said last week. So this isn't so entertaining for China, though, because their imports dropped 12.4% in July, year over year. And you think, okay, imports, that's not that big of a deal. They need a lot of imports, but they're an export nation. 14.5% down in July, year over year. That's after a 12.5% decline in June. That's the fastest pace of decline since the onset of the pandemic in early 2020. That's China's economy rolling over. That's China invading Taiwan, in my opinion. So, Miles, I'll back up what you're theorizing.
Yeah, and I think you're seeing that play out across the board, like you mentioned, Rob, in all commodities. And we're seeing it here in silver. We're seeing it in platinum down pretty significantly. And platinum actually putting in a lower low this week. So we did have a bit of a breakout to the downside on platinum. It did go all the way up to almost put in a higher high a couple weeks ago, but then didn't. And now we're back to a new lower low. And gold is down. Gold continues to slide down. Now, we were talking about gold hopefully coming back down to around that 1910 mark, 1900 mark. Maybe we get a double bottom here at the end of the summer. But we saw a similar thing in gold that we saw in silver, that we saw in platinum. We saw things start to move back up, look like they were going to have breakout moves, and something kicked them in the shins and pushed them back down. So it'll be interesting to see if gold and silver follow suit with platinum, in that we do end up putting in lower lows in gold and silver market. Now, since we're talking about that, and it's been a few months since we looked at the grand scheme of things, when gold was first going down to that 1900-ish mark, we're still talking about the highest likely reversal point, right? We're still talking about the 382 fib. We're still talking about gold starting at 1600 and ending at 2100. A move down to 1900 is still insignificant.
It's the least shallow hole that
Correct.
You're digging from that top, yeah.
Right. So gold conceivably could offer better opportunity in the future. Now, I don't necessarily think that's going to be the case, because there are seasonal pressures that we want to keep in mind here. But seeing gold down here in the low 1900s again, that's okay. We were here a month ago. I find it interesting that over the last month we had this kick up and then back down across the board. And I'm wondering what caused it, because we saw it in the Dow too. I mean, this is a weird week to me.
Yeah.
Metals are down, real estate's down, the equity market's down, the dollar didn't really go up. I mean, it's trending up, but we didn't see a significant move up. And it seems like over the last 2-3 days, everything is declining. Where's the money going? What's the money running into?
I think it's going to cash. What do you think, Rob? I mean, isn't this kind of giving you the sense that as things get more unsettled, we're seeing this replay of people moving to cash?
Yeah, I do. I think they're waiting for an opportunity. They're waiting for a break, and then they want to buy in again.
Yeah, in whichever asset class presents itself as the most undervalued.
Right.
We've talked about this too before, but if there's a growth component to a portfolio in the form of stocks and bonds and mutual funds and some of those speculative investments where you're looking for aggressive return, and there's a savings portion where you're just kind of happy sitting in cash waiting for opportunity, low yield returns, and then you have your insurance or physical commodities portion. If every portfolio has those three representations in it, and you need to be diversified amongst all three, you naturally have to expect that two are going to be doing well while one is not. So it may be, the dollar didn't have a big rally, but it didn't drop. So the dollar has been the winner this week.
In spite of all the bad news.
That's right, because the world trusts it more.
Yeah.
So that's okay. The dollar's been strong, and yet here the equity's rolling over, and then the next day you'll see gold will drop and that sort of thing. But if you have balance in those three aspects of the portfolio, that's where the real magic is. That's where the portfolio performance over time comes from. So you can't leave any one category. You have to have your physical precious metals. You have to have your growth. You have to have your savings. And with that, you can weather any of these storms, whether they be technical corrections on a chart or geopolitical tensions or other underlying fundamentals that are putting a lot of downside pressure in any one aspect of your portfolio.
And I think people are dealing with a lot of fatigue, too. There's just so much bad news and has been for several years now. I think there's a lot of fatigue. I think people are just sitting tight.
Well, what they're not stopping is their debt accumulation.
That's true.
They're sitting tight. And yeah, a lot of people, investors might be moving to the dollar. The average citizen is just looking for a dollar.
I think you unironically used the word tight there specifically because I think wallets are tight.
Yeah, wallets are tight. Yeah, credit markets are kind of tight. But our total household debt, you guys just reached $17 trillion as of the second quarter of 2023. So that's household debt, $17 trillion. Credit card debt exceeds $1 trillion now. And that grew like $45 billion in the quarter. That's desperation. That's people that are living on credit. And even Henry Paulson and Timothy Geithner, who seem to be unable to separate ever since the financial crisis with Bernanke, the three stooges there leading us out of that thing. But they came out this week and said, we have to deal with U.S. debt before it gets even harder. And I don't know how much harder it can get. It's almost like Washington doesn't care. But they say we have to tighten spending and we have to increase revenues. Well, welcome to Economics 101. Isn't that what Washington's always supposed to be doing? But we're not. We're doing the opposite. And as a result, our country is looking much like the citizenry in digging deeper holes for ourselves.
Well, that's what happens when you stand before Congress as an expert in something, and you're talking to a group of people who are more interested in fixating on the other party being to blame for the problem. So love them or hate them, you've still got experts in the field testifying the same thing we've been saying for a while here, and a lot of people have as well, is we've got to fix the debt problem. You can't increase the borrowing and increase the spending at the same time. And you just brought up a thing I didn't know. I didn't realize that U.S. consumer credit card debt had broken $1 trillion. That's enormous, especially when you're talking about massive quantities of banks and credit unions where consumer debt is one of their biggest investment classes. So what do you do as a bank account holder at a private institution that is across the board investing in significant positions in the equities market, which we think we're seeing some topping action in the Dow right now, significant positions in commercial real estate when we're in a recession and we're losing brick and mortar businesses still today, significant positions in consumer lending, which is pretty much everything that isn't a mortgage, right? So that's your car loans and your boat loans and your revolving rates of credit, like credit cards. Where do you put your money? I mean, we still have to use a bank. What do we do about the banks?
Banks are great for transactional purposes. They're not the same as they used to be. You're now an unsecured creditor, with the laws being for bail-ins and everything else. And we've been talking a lot on this show about banks since the first of the year, the 4 large failures of banks. But just this week, Moody's Investors Service lowered its ratings for 10 small and mid-sized lenders and said that it may downgrade major firms, including like U.S. Bancorp, Bank of New York Mellon, State Street, Truist Financial. Those are huge institutions. And if they get downgraded, then that's different. That's like Fitch downgrading the U.S. debt last week. But that's higher funding costs, regulatory capital weakness, rising risks with commercial real estate, which you just alluded to, these vacant stores, and with banks overexposed to some of this commercial real estate lending, that's a default on a different scale from residential real estate. And then deposits fleeing for return. You're right. Where do you go? Where are people going, Rob?
Yeah, well, they're going to their broker who can shop CD rates for them and get them 5.3% on 3 months, small CD rates. So they're looking for yield.
Totally agree.
But if this trend continues, we could see another batch of banks going under, and that could actually trigger a sell-off on Wall Street.
I was looking at the ratings service that we do these bank ratings for our clients through, and the number of downgraded banks this quarter, it's pages long.
Yeah.
So we're talking about Moody's downgrading its ratings for 10 small and mid-size. We're talking hundreds of banks have been downgraded by other services as a result of either liquidity concerns or capitalization concerns.
And a lot of these banks have looked up for clients while we've been doing these bank ratings over the last few months. They're not downgrades from like A- to B+. They're downgrades from like A- to C+.
Yeah,
like they're skipping grades,
yeah,
which is crazy to me, which means that there's massive liquidity problems or massive loan balance problems.
Well, that's why we have Rob on the show, because he skipped grades the other direction going in, smartest guy in the room. So you just don't want to do it to the downside.
Right. I think I did that a few times.
Well, and how would that coincide with what you mentioned? I think it's worth talking about. Dow looks pretty toppy. I mean, the action we've seen in the Dow, it's had a real strong rebound. We're still not back up to break even. Like, I'm super happy for everybody bragging about how great the Dow's doing this year. But if you've owned stock longer than a few months, you're actually still at a loss. So let's not forget that.
Well, isn't the NASDAQ showing even more weakness?
Yes.
I mean, the volatility was there in the fall and the decline. NASDAQ's outperformed the upside, and now it's starting to underperform
downside.
again to the downside.
Yeah.
And by a significant number of measures, from moving averages and relative strength indexes and a number of things that we look at in the charting world, I think the Dow might have one last good gasp up. Well, that's going to take us right to a double top. Now, I'm not saying the Dow turns around and loses 15,000 points, but we got all the way down to what, 28,000, 26,000 on the Dow, somewhere in there. A decline by half when we're talking about a massive banking industry that has 20, 30, 40% of their assets in equities, plus the real estate, commercial real estate aspect you just brought up, plus the credit card problems that you just brought up. And now, Rob, I think we're exactly what you were mentioning, a whole new wave of medium and maybe even a couple large banks having to sell assets out to somebody else.
Yeah, I think this is starting. I think it's starting.
I do too. And now is the time. We talked last week. This is when you buy a hedge.
Yeah.
When you feel like that which you're comparing it or hedging against is overvalued and your hedge is undervalued, gold and silver are giving you a real gift right now. How about, okay, silver's down 14% from just a couple of weeks ago. How about an additional 10% bargain?
Yeah.
On the premium.
Yeah.
Nobody's talking about it, but the premiums have started to soften.
Hey, Silver Eagles are only $1 more than Silver Maple Leafs. Now, a year ago, they were like $5 or $6
A couple
more.
months ago. Yeah.
Yeah, even a couple of months ago.
Yeah.
In fact, I just talked Friday, a guy had bought, he sold 4,900 Silver Eagles to me back in the fall. He bought 7,000 ounce bars. It was around 6,900 ounces. I just called him like, John, I can give you back your 4,900 Silver Eagles plus another 772. It hasn't even been a year yet. So he closed the loop and gained more than $1.50 box of Silver Eagles with no money out of pocket, just playing the premium, the drop, the gain in premium, and then the collapse in premium. So if there ever was a time to look at the market, now's a great time.
So that's going to do it this week for Golden Rule Radio. If you'd like to speak with one of us about keeping track of that market for your own personal portfolio, why not give us a call? We can be reached at 800-525-9556. We can also be found on our website at mcelvaney.com. We're on Twitter at ICA Gold and Facebook at McElvaney Financial. Thanks for listening and have a great week.